Hey everyone, I thought I would do a very nice video for beginners on ETFs, the different types, what they are, what each type is, and the risks involved. So let's get started. So I know this is very simplistic, but basically an ETF is an exchange-traded fund. Fun fact, if you ever get stopped on the street for a street interview and you know what it is, you win $100. So an ETF is basically an investment that holds many types of stocks. It trades just like the stock market, and it lets you invest in multiple companies all at once. Essentially, instead of buying individual stocks like Apple, Microsoft, Google, Amazon, you buy one ETF that buys all four of those, including tons of other stuff. So it diversifies the risks. So you're not buying one individual, you're buying an ETF which buys portions of those. So when you buy an ETF, it's much cheaper most of the time than buying individual stocks, and you get portions of every stock that you're buying, which over time you will accumulate tons of the stocks if you're investing for 30 years. So the benefits are that an ETF diversifies. Instead of just buying one like Amazon, you're buying 30 different companies like Amazon, or that have profits like Amazon, and companies that are really good in the sense of stock market wise. And it is less risky than buying one. It's low cost as well. A lot of ETFs have very small charging values, so meaning they'll only charge you 0.3%, 0.03%, something small. And you have to look at those when you are buying ETFs. How much does the manager of the portfolio charge you to manage the fund? It's also very easy to buy and sell. Depending on whether it's an IRA or brokerage, you'll be taxed, so be careful. But you can literally, as simple as sell, buy with a website and a button. Very easy. So the risks are the same as buying individual stocks, obviously, but it's less risky because if one stock falls, you still have, let's say, 100 other ones if you're like in QQQ, which is about 100 stocks. But imagine you're in a global stock which invests in the entire index, like a VOO or a VTI. There's 500 to over 3,000 stocks. So if one falls, way less risky. So I want to go over the types of ETFs. There's so many types, and if you're watching this video and are confused, this will help you a lot. At first, I was very confused, but you'll see a chart at the end of the video. If you want to just fast forward to that chart, that'd be great. So broad market ETF is like an SP 500 or a total stock market ETF, like I said earlier. If you do a S&P 500, you could do the total S&P, you could do the top companies in the S&P, and we'll look at some. You could do VTI, VOO, VT. All those will hold hundreds of stocks to thousands of stocks, and it tracks the S&P or whatever index you're using, whether it's the Dow or the NASDAQ. And it's very low risk, but because you're buying so many different stocks, but it's a stock market as well. And it's good for beginners. A lot of people even have those a broad market ETF as their main portfolio base, like 40-50% of your entire portfolio. Or if you're more experienced, you can do a sector ETF like technology, healthcare, energy, finance. So you can Google what are the top specific sector ETFs and invest in that. You could also do a growth ETF. This is great for beginners because a growth ETF will have very high chances of skyrocketing, but can also fall at a whim. And it's a very high risk, as you see here. This is like QQQ, mostly technology based. Then you have a dividend ETF. A dividend ETF is usually very low gains per year, but it pays you on a regular quarterly basis, most likely, and it's income. A lot of people who are near retirement, dare say we old people, will more have dividend portfolio, like 50, 60 to 70% of their portfolio, because it's less risky and they're guaranteed an income and they can remain invested and only sell off a small percent per year. Next is small cap ETFs. These do better when the interest rates are lower. It's also high risk because they're new companies that haven't really been established yet, but there's also potential for very high growth. Imagine if one of these companies get a really good government contract, or they get bought out by a massive company and they merge, you can have a really good year that year with small caps. Then you have international. International right now is doing very well. International is essentially other companies from other countries besides your home country, and it invests in a broad range of those kind of companies. These have been doing very well recently because of the shift in globalism, and it is diversification when you have other stuff just in your home country. So, and then there's some terms you should know. I was saying earlier, an expense ratio is one that is the cost to manage that fund. So it'll take, usually on a monthly basis, quarterly basis, part of your earnings. So over 30 years, it can be a lot. So if you're in one that's like a 1% ratio, that's a lot. An index is basically like the portfolio. An index is basically like the S&P, the Dow, the Russell. It's it's traded on, that ETF. The dividend is the cash payment you receive, and the volatility is how much risk is involved. So when you are doing a broad market ETF, again, that's the entire market. That's like VOO, SPI, SPY, VTI. If you're in a sector specific, those are going to be all over the place, like XLK. Then you could be in a growth fund like QQQ. You could be in a dividend fund like SCHD or VIG. You could be in a small cap, and there's hundreds of those, or international like VWO. So when you are doing a portfolio, you're going to want to have at least 3 of those options: a broad market, a sector, growth, dividend, small cap, or international. Thank you for watching, all, and you can see this chart. I will share it in the first comment in the video.